Welcome to the deep dive. Today we're jumping into the Q3 2025 financials for a major player in U.S. housing finance. Always a lot to sift through here.
Absolutely. And our mission today really is to cut through that complexity. We want to quickly pull out, the key financial wins, pinpoint where the housing market's feeling the strain because single family and multifamily are quite different stories right now.
Right.
And finally, tackle that ongoing, frankly, bizarre situation with their regulatory capital.
Okay, let's unpack this then, the big headline figure. Q3 net income hit $3.859 billion.
Mhm.
Now that's up 16% from the last quarter.
Yeah, quite a jump from Q2's $3.317 billion.
It is. And a jump like that, well, it suggests things are firing on all cylinders. But the real story here, it seems, isn't really about more business or higher revenues. It feels more like internal adjustments. Yeah, if you look past that big 16%, the revenue picture was actually pretty steady. Net revenues were what, $7.307 billion? Fairly stable.
That's right. Stable. So this surge, this profit boost, it really came from managing costs and, maybe more importantly, managing their view of risk.
Okay, so what was the biggest lever they pulled?
It was a dramatic cut in their provision for credit losses. Essentially, how much money they set aside anticipating future loan problems.
Ah, okay. So they're feeling less worried this quarter.
Seems that way. Or at least they adjusted their models. That provision dropped, get this, by 64%.
64%, wow.
Yeah. In dollar terms, it went from $946 million set aside in Q2 down to just $338 million in Q3.
So you instantly add, what, over $600 million back to the bottom line just by changing that outlook?
Exactly. That single move dramatically changed the net income picture for the quarter. It was the largest driver.
But hang on. If the big jump comes almost entirely from cutting that risk cushion, doesn't it make you wonder? I mean, is this sustainable? Or is it more like a one-off adjustment because maybe Q2 was, I don't know, a bit too pessimistic?
That's the critical question, isn't it? And look, the provision change is definitely the biggest swing factor, no doubt. But there's also some solid evidence of, let's call it, structural improvement happening too.
Okay, like what?
Well, the second driver was genuine efficiency. Their non-interest expense, think operating costs, that decreased by a solid 8% compared to Q2.
8% is pretty good.
It is, and they specifically called out cutting $65 million in administrative expenses. That's actually a 7% drop compared to the same quarter last year.
Ah, okay. So year-over-year savings. That sounds more durable. Even if the risk provision cut is maybe temporary, they are running a tighter ship.
Absolutely. And we can see that reflected in their efficiency ratio, that metric that shows how much it costs them to make a dollar of revenue.
Right. Lower is better.
Exactly. It improved to 29.3% in Q3. That's down from 31.5% in Q2. So it tells you they're getting more profit out of their existing operations. The cost management is real, even if maybe the credit loss relief doesn't repeat at this scale next quarter. Now, we should probably connect this performance to, the bigger economic picture. The environment they're operating in is getting, well, trickier.
How so?
The U.S. economy, it's still growing, sure. Q2 GDP was up 3.8%, which is healthy. But the forecast for the full year is slower growth than we saw in 2024. Things are cooling off.
Unemployment. That's key for mortgages.
Right. And we're seeing the unemployment rate tick up just a bit. It hit 4.3% in August, up from 4.1% in Q2. And the projection is for it to nudge up again slightly in Q4. Not drastic, but the trend is there.
Okay, so a cooling economy, maybe slightly rising unemployment. And that feeds right into their housing market forecast, which I found pretty interesting in the documents.
What stood out to you?
Well, on the surface, national home prices grew, they estimate, about 3.4% in the first 9 months of 2025. Sounds okay, right?
Moderately positive, yeah.
But their forecast for Q4 is actually for a decrease in home prices. A decrease. And that pulls their whole projection for the full year down to just 2.5% growth. That feels, well, pretty conservative. Almost bearish for Q4.
It is conservative, and I think that caution is really warranted, especially when you pivot from single-family homes, owner-occupied, to the multifamily market, apartments, rentals.
Ah, yeah. That seems to be where the real pressure is.
It is. Multifamily vacancy rates are holding steady around 6.5%. But here's the context. The long-term, 15-year average is only 5.1%.
So significantly more empty apartments than usual.
Exactly. And when vacancies stay elevated like that, way above the norm, you know what happens next? Rents start to soften.
Which they did. Effective rents actually decreased slightly in Q3 by 0.1%. Not a crash, but definitely not growing.
Right. But here's the really stark number you need to focus on. Multifamily property values, they estimate values have fallen 19% since peaking back in Q2 2022.
19%. Wow. That's a significant drop in asset value.
It's huge. And why should you, the listener, care about a 19% drop in commercial property values? Because the collateral underpinning billions in multifamily mortgages is suddenly worth a lot less?
Right. The cushion is thinner.
Much thinner. That 19% drop is a flashing indicator for potential future losses. It feeds directly back into those credit risk models we were just talking about. It's clear signal of, frankly, serious pain in the investment property sector, mostly driven by higher interest rates, making deals harder to pencil out.
Okay, so let's break down the two main business segments then. Starting with single family, that's usually the steadier part of the business, right?
Typically, yes, it's the bedrock. And Q3 looked pretty solid. Net income for single family was $3.085 billion. That's up 13% from Q2.
In loan volumes.
Acquisitions were up by about $6 billion, which they said follows typical seasonal patterns. Summer buying season feeding through. That brings their total single-family guarantee book, the loans they backstop, to a massive $3.588 trillion.
Brilliant, yeah.
Yeah.
Okay, and the credit quality within that huge book.
Still looks very strong, actually. The series delinquency rate loans over 90 days past due is incredibly low at just 0.54%.
0.5%.
Okay. And a big reason for that is how much risk they've managed to offload. This is key. Nearly half, 47% of that entire single-family book has some kind of third-party credit protection.
Like those CAS or CRT deals they do?
Right.
Or just regular private mortgage insurance?
Exactly, all of the above. They've effectively pushed a huge chunk of the potential default risk onto others, investors, insurers.
That makes sense. Now, we did notice one structural point in the notes, the servicing concentration, with the recent Rocket and Mr. Cooper merger.
Ah, yes. That's definitely something to watch. Post-merger, Mr. Cooper now services roughly 16% of their entire single-family guarantee book.
16% for one servicer. That's a lot.
It is a significant concentration. Good for efficiency for Mr. Cooper, probably, but regulators always keep a close eye when servicing gets that concentrated. Just a point to monitor.
Okay. Now, let's pivot to multifamily. As you said, more stress here, but the Q3 numbers looked strong on the surface.
They did. Net income was up significantly, 33% quarter over quarter, hitting $774 million. And acquisition volume new loans was really booming, up 47% for the first 9 months of 2025 compared to the same period last year.
47% growth in new business. That's huge, especially given the property value drops you mentioned.
It is. And that strong activity grew their total multifamily guarantee book by 7.3% year over year, reaching $521.3 billion. So they're definitely still doing a lot of business.
So how do we square that? Massive volume growth, good income, but underlying stress with vacancies and values. What about the credit quality within that multifamily book?
Ah, that's the tension right there. Despite all that new volume, the criticized loan population loans regulators are worried about, it's still elevated. It's at 6%.
6%. How does that compare?
Well, it's slightly better than the 7% it hit at the end of 2024, so maybe stabilizing. But 6% is still quite high historically.
And what's driving those concerns?
It's almost entirely about the high interest rate environment, especially hitting adjustable rate mortgages. When those rates reset higher, it puts a lot of pressure on the property owner's ability to cover payments, especially if rents are flat or falling slightly.
Makes sense. So how do they manage that risk? Is it similar to single family?
Mostly different, actually. From multifamily, the vast majority, they say substantially all of the risk is managed through their delegated underwriting and servicing program, or DUS.
DUS. Okay, what does that mean in practice?
It essentially means their lending partners, the banks and financial institutions originating the loans, retain a significant portion of the credit risk. So if a loan goes bad, the DUS lender takes the first loss, not the main entity.
So risk sharing, but structured differently than in single family. That explains how they can keep originating loans even with market stress. The initial risk buffer is with their partners.
Precisely. It allows them to maintain volume while insulating themselves somewhat from the immediate market pain.
Okay, now let's get to the elephant in the room, the capital structure. This is where, the strong operational results kind of collide with the reality of still being in government conservatorship since 2008.
Right. This is the fundamental constraint. Operationally, as we've discussed, they are building wealth. Their net worth grew again, reaching $105.5 billion as of September 30th.
$105 billion, that's up $3.9 billion just in Q3.
Exactly. They're retaining their earnings, building that cushion, and $105.5 billion is objectively a massive amount of net worth.
It's a huge, but there's the paradox of the regulatory capital rules. Despite having over $100 billion in net worth, they're still considered massively undercapitalized by their regulator, FHFA.
Massively is the right word. As of September 30th, the total capital shortfall, factoring in all the required buffers under the official rules, was still an astronomical $215 billion.
$215 billion short. It's hard to even wrap your head around that number.
It really is. Just for context, that shortfall is bigger than the entire annual economic output of many countries. And their core capital measure, the Common Equity Tier 1 or CET1, was actually negative by $44 billion.
So despite earning billions, they're still deep in the regulatory hole. Is there any progress?
Well, yes, some. That $215 billion shortfall is actually $12 billion smaller than it was at the end of 2024. So the retained earnings are chipping away at it. But it's like bailing out the ocean with a teaspoon.
Yeah. And this whole situation creates this really bizarre dynamic because of the agreement with the U.S. Treasury, the senior preferred stock agreement, right?
Exactly. It sets up this, well, it feels like a regulatory treadmill. The entity is required to build capital, build net worth by retaining its earnings.
Which they are doing.
Yes, but under the current agreement for the senior preferred stock, or SPS, every single dollar of net worth they build increases the amount the government is eventually owed under that stock agreement.
Wait, say that again? They earn money to build capital, but that act of earning money increases the government's claim.
That's effectively how the liquidation preference works. As net worth goes up, the Treasury's claim, the liquidation preference on that senior preferred stock, also goes up.
So they're running hard, generating billions in profit, but the finish line for paying back the government keeps moving further away because they're successful.
That's the dynamic. Because net worth grew in Q3, the aggregate liquidation preference on the SPS climbed to $223.1 billion as of September 30th, and they project it'll hit $227 billion by the end of this year.
It's, a zero-sum game almost.
It feels structurally counterintuitive. And just one more point to underscore how tied their fate is to the government. Remember back in May 2025, Moody's downgraded their long-term debt rating.
Right, to AA1 from APRA.
Yeah. That wasn't triggered by anything the company did wrong internally. It happened simply because Moody's had previously downgraded the U.S. government's sovereign rating. Their creditworthiness is essentially capped by Uncle Sam's.
Okay, so let's try to pull this all together. Synthesize the core takeaways for you listening. Hashtag, outro.
So what does this all really mean? Operationally, look, the organization is running pretty effectively. Q3 saw strong income. Yes, driven partly by that big cut in the credit loss provision, but also by genuine cost management.
Right, they're fundamentally profitable. They've built up this huge $105.5 billion net worth cushion.
But that operational success is happening completely overshadowed by the conservatorship and this just staggering regulatory capital shortfall of $215 billion.
And the path out of conservatorship, which is supposed to involve building capital through earnings, well, as we just discussed, that very process makes the government's financial claim even larger because of the senior preferred stock agreement.
It creates this fundamental tension. They need to earn their way out, but earning their way out digs the STS hole deeper under the current rules.
So the provocative thought to leave you with is this. How does an entity escape this kind of financial catch-22? Building capital organically is the stated goal, but when that capital generation automatically increases a massive government claim, what does the path to eventual independence actually look like? It's not just uncertain, it seems structurally designed to be incredibly difficult. That's the core tension to keep watching.